I might just run through quickly all the things that I think someone needs to consider when they're working out what the right structure is for them.
Okay.
So the first one is asset protection, and this is segregating the risk associated with the business. So risks to creditors, risks to employees, risks of insolvent trading, or, you know, all of that. Segregating those risks associated with the business away from your personal assets, so that the wealth that you have accumulated independently of the business is not on the line to satisfy those business risks. So that's what I mean when we're talking asset protection. And then also, if you've got a few different business activities, making sure we're not tainting each other, so that they're kind of, we've got firewalls between each of the activities. So if one goes belly up, that's fine. Write that off as a loss, but we're not exposing all the other wealth. I think the next factor would be, how simple, you know, how much do you want to compromise simplicity? Like, because often as we're getting best practice for asset protection and tax and all of that, we're adding in trusts, we're adding in companies, we're adding in ongoing administration costs, taxation return costs, tax advice. So it's a balance between, if you're a person who just wants everything simple, you might take a bit of a hit and have some, you know, weak links on these other factors in favour of keeping it simple, or vice versa. You just have to accept that to get best practice and the best outcomes on the other, like tax and asset protection, then maybe, there's going to be a little bit more pain than being a sole trader. I think we've talked about the income tax. For the capital gains tax, and I think this really flows into some of the things you raised, let's start with the end in mind. So some structures, you have capital gains tax 50% discount when you sell the asset. So a trust and an individual, if they've held an asset for more than 12 months, they get a 50% discount on the capital gain. But if a company is selling an asset, they don't get the gain. They don't get the discount, which might be fine if you are an individual or a trust who owns shares in a company, and to sell the company assets, you actually sell the shares, then you do get the discount that way. But just kind of going, well, what might the exit plan be? Are we going to sell off discrete assets, and what's the tax going to be then? Can we apply any of the small business concessions? Just start with the end in mind so you're not in the wrong structure.
And that's something that we see with the small business exemptions. Kind of clients come in and say, no, I'm winding up the business, I'm selling it, and we actually have to dig through and say, well, what is it that you're actually selling? Are you selling the shares in the business? Are you selling the things that the business owns and you're retaining the shares? Like, what's actually being sold there? So that then you can work through what exemptions you can and can't use and how that might unfold. So often clients, I find, they don't know. So you've got to press the accountant more than anything to find out what's actually being sold here.
Yeah, exactly. Because to them, it's just their business. But when we look at it, you know, there's discrete layers. I guess that also ties in with what is the sort of, you know, the 5 to 10 year plan of this business. Are you going to bring in investors? Like, is that likely? Because you can't introduce investors into a discretionary trust. You can only your family can benefit from that, and no one has a fixed entitlement. So if you were really, you know, if you get to that point where you've put your business in a family trust and you want to bring in investors, you're going to have to restructure and, you know, pay some fees to manage the tax and maybe stamp duty on that. So if you know that that's likely, maybe you would start in a company. And then also, I suppose, I would look at your own succession objectives. Is this the business you're going to hand on down through the generations? Are you building a legacy here, or have you got a legacy business? How would that tie into estate planning strategies you could use? And then lastly, this isn't always relevant, but have a look at the licensing requirements or like the framework that you have to operate in. So I know in Queensland, the construction industry, they have quite a few restrictions coming through from the QBCC about how much assets they need to keep in their trading vehicle,
Okay.
and that kind of thing, which limits the strategies. And, if you've got a trust and you can't keep retained profits, then how does that all work? And so just kind of overlaying those industry-specific restrictions as well. So I know that sounds a bit like overwhelming, like there's a lot of things you have to think about, but often it's kind of like, yes, you're at the size where a discretionary trust would be a great trading vehicle for you, or you need to go corporate side.
The battery died on the laptop here.
Oh,
Sorry. Thank you.
pleasure. We have a great afternoon.
Yeah, you too. Talk to you soon. See you, Tara.